When you think of a bank, what does a bank do to make money? They lend money, right? So when you need money for a car, for that rental property you're gonna buy, that Airbnb property, or that flip, you typically would think, well, I gotta go to the bank and I gotta try to get a loan. That's how banks make money. They pay you interest on the money that you deposit with them. Then they take your money that you gave them as a deposit and they lend that money out at a higher rate of return, making a spread. It's such a simple concept, right? You deposit money there, you give the bank control of your money while the money's on deposit. The bank lends that money out at a higher interest rate and makes a spread. And they do this over and over and over again. We're not even going to get into fractional reserve banking, but at the base, that's what a bank does. How much risk does the bank take for doing that? Not a whole lot, right? When a bank lends you money for your house or for your rental or for your Airbnb or for your car, what does the bank ask for? There are two things. Number one, they ask for collateral. They want a mortgage on the house. They want a lien on the car's title. Why? Because they don't trust that you're going to pay them. And therefore, if you don't pay them, they are going to foreclose on the house, they're going to repo the car, or take back whatever the asset that collateralized the loan was. So therefore, a bank doesn't take on a whole bunch of risk because every loan is calculated and collateralized. So now let's flip gears. Let's talk about how you make money. Well, you put money in 401ks like you've been told. You put money in the bank. Oh, and how much does the bank pay you? Well, not a whole lot, but they make a whole lot. You put money with your advisor, with your broker. You put money in stocks. You take on a ton of risk with no collateral. You don't have a mortgage on that stock. You don't have a lien on that company's assets, do you? Probably not. You're taking a ton of risk with what you're doing to make money, where banks take on very little risk. So, I'm sorry, but doesn't it just sound like it makes more sense for you to learn how to be your own bank? Well, that's what we're going to talk about. We're going to talk about how you can be the bank, how you can be the private lender, and how you can build your own private banking system. And I want to show how you can do this with as little risk as possible by following simple steps and making money not just once, but twice on the same dollar. Money! Just like Pink Floyd's song Money, that's what we're going to talk about, your money. But we're going to talk about how you can be the bank by doing exactly what a bank does, and that is be a private lender. So I've created this platform, shameless plug, called privatemoneyclub.com. You should check it out. Actually, you should go on there, create a profile, put up a photo, tell people what you want. There's only two types of people in the world: people that have money and people that need money. Are there any other types of people? Some have, some need, but wouldn't it really be cool to understand what problem each of them have so that you then could solve their problem and make more money? Well, let's just dissect that, because it's really just as simple as the two types of people. So people that have money, they all have a single solitary problem. They want to make more. And then people that need money have a single solitary problem. They need money to make more money. So why don't we just solve one of the two people's problems? So that leads me to privatemoneyclub.com. That's exactly what it was created to do. Solve a problem for two people, people with and people that need, by bringing them together in a community, not getting in the middle of their deal. Because, oh my gosh, don't you hate it when someone, there's some money in the cookie jar and you got too many hands in there? The only people's hands in the cookie jar should be the person with money and the person that needs money, not the person that creates the platform. No, no, no. So we stay right out of the deals. But here's the thing. What's the most effective way for you to lend on Private Money Club? Well, if you said, well, the best way would be what you just said, be the bank. You were absolutely correct. The best way to lend money is by you being your own bank. But by being your own bank, I don't just mean the act of, because you got to act as if. So if you're going to be the bank, you got to mimic a bank, and you got to act as if you're the bank, which I'm going to show you in a second on the board exactly what being a bank is. But let's just talk about one simple fundamental, and that is money. How do you make more money by doing the act of being the bank? Well, before I get to that though, because this is going to get really good really fast, I would like to ask you for a favor. And I know it's hard to see, but right here, yep, right here it says subscribe. Click the subscribe button, and right above there's a little bell. What I'd like you to do is smash that bell. And while you're at it, just, whether it's a left or right hook, it doesn't matter. Oh, jeez. You all right? Sorry. Smash the bell. People have to get hurt for this, so I really need you to take advantage of that. Anyway, let's get back into it. Now, what if I just told you that by changing just one thing, and that's where your money or your savings goes first, you can make money twice on the same dollar. Some of you are thinking, oh, that's too good to be true. Oh, that's a silly sales technique. Oh, that's a scam. Do you even know what I'm talking about? You probably don't. But if you do, just change where your money goes first. And you do what the wealthiest families throughout history have done with their money. Who? Oh, you're asking who? Yeah, I saw that in the comments. Well, let's start with the Rothschilds. Okay, you can study the Rothschild family, and then the Rockefellers, and then you can study the Morgans, and then the Stanley. So pretty prominent families, right? And then we can look at Walt Disney and Ray Kroc and Doris Christopher. Okay, yep, some good business owners. And then we can look at Warren Buffett. We could look at McCain, and we could look at even Biden. I know the dude. Yeah, we could look at him. But they all, politics and business owners and wealthy bankers, they all did the same thing. They changed where their money or some of their money went first. And then they deployed that money out there to be the bank, to buy businesses, to invest in investments like oil and gold and silver and businesses and textiles and McDonald's and Walt Disney World and Pampered Chef. I'm getting carried away. But they all did the same thing. And that's what I'm telling you should do, is just change where the money goes first. Instead of using somebody else's bank, like Bank of America, Wells Fargo, JP Morgan, Chase, all of those. Why don't we just put our money with a more secure financial institution, one that all those families used for a long time, and that is a giant mutually owned insurance company, a life insurance company to be specific, but it's got to be mutually owned, dividend-paying life insurance company. So you can't just walk into the life insurance company and be like, hey, guys, I'm here, I got some cash, and I'd like to deposit that money in your awesome mutually owned, dividend-paying life insurance company. Where do I go to make a deposit? And they say to you, sir, you go back out the door and you go across the street to that bank over there because they're a deposit institution. And you think, no, I want to put my money not in their bank, I want to put my money in this insurance company because you guys pay guaranteed interest for the rest of my life. You guys also pay dividends, right? Yep. And if I do it properly, you pay me my interest and dividends in a vehicle that's, don't tell anybody, but tax-free? Oh, that is the case. It's protected against judgments and liens in most states. Oh, wow, sounding good. And I know this is pushing it, but someone told me that when I put money in that machine, I can then take that money out, but my money never leaves the account, so my money gets to earn compounding interest on an uninterrupted basis. Is that real? Oh, it is. So what is this awesome place where I should put my money within this giant mutually owned insurance company? Whole life insurance. That's right. But it's specially designed and engineered to do what we're going to talk about. So without me going too much further, I want to show you how to be the bank. I want to show you how to make money twice on the same dollar by changing one thing, and that's where your money goes first. And then we're just going to basically do what the banks do. So come over here to the board. Let me show you what I'm talking about. All right, so let's dive into this first, and then we're going to go into some numbers. I want you to understand how to be a bank. Remember I said how a bank makes money? It's a spread. they pay you interest, they lend the money out at a higher interest rate. So if they paid you 4 and lend it out at 7, they make a spread of 3. And then the money gets deposited back in the bank by the seller who sold the house to you or whoever took the mortgage out, and then that money gets lent back out on a car at 8%. But if they paid you 4 and they charged 8, they make a spread. Same thing, home remodel loan, they charge 9%, 9 minus 4, 5% spread. And over here, they pay 4 to you, they charge 12 on the debt consolidation loan, that's an 8% spread. If you did the math, their spread was 20%. That is 5 times more, or 500% more than you earned on your deposit. This is how a bank does this, but think about each time that the bank did this loan. Except for the debt consolidation loan, every one of these were collateralized loans. Therefore, minimizing the risk, and this one required a mortgage and a note, this one required a note and a lien on the car, this one required a second lien position called a mortgage and a note. But here's the cool thing, all we're gonna do is we're just gonna change the name on the bank, and we're gonna put your name on the bank. That's all. Pretty simple stuff, right? But let me now show you how, by applying banking strategies and taking back the banking function, how you can make money twice instead of once by doing private lending on privatemoneyclub.com, the place where there's 2 people. And if you're a borrower, I'm not gonna leave you out. I promise you, we're gonna take care of you as well, because there's people that need money and people that have money, and we're gonna bring them together. So in order for you to be the bank, you got to stop using traditional banks, and you got to put your money where the wealthiest families did, as I mentioned earlier. So I want to show you what that looks like, okay? I'm going to use a case study, an actual policy that we did for another lender. So this gentleman's name was Kevin. I can't give you his last name, but we're going to look at his numbers and how he used that bank, his private bank, which is none other than a specially designed whole life with a mutually owned life insurance company that pays dividends. That's all it is. And I want to show you the benefit of him lending money from the policy versus lending from a traditional bank. So check these numbers out. So this is Kevin's policy. So Kevin came to us after he saw a video much like you're watching now. Oh yeah, by the way, subscribe to this channel and you can see all these videos, and click that little bell up top so you're notified. But Kevin saw this, and Kevin was a real estate investor. But he was a real estate investor on both sides. Sometimes he needed to borrow money, sometimes he wanted to lend. And at this point, he was actually looking to do a real estate deal. He was buying an Airbnb, so he had saved up a little bit of money. And after watching the video, he said, hey guys, if I just change where this money is, it was about, he had a little bit more than 50 grand. If I change where my 50 grand is, and I change where the savings goes, and I put it into this specially designed and engineered policy, would it be better if I then use that to buy the property down the line? And then just take the rental income from the Airbnb and put it back into the policy. I mean, to him it made perfect sense, and to you listening to this, hopefully that made sense. He just, instead of using somebody else's bank, he was going to use his own bank, but the money he had was sitting in a traditional bank account. And he changed it to be into this policy. So look at the numbers. So here's the deal. Now I'm going to give it to you in 2 scenarios, right? I'm going to talk about Kevin's policy, where he put $50,000 into the policy as a dump in, and then each month he wanted to save $500 a month. So he wanted to dump 50 grand in and save $500. Now, if you look at these numbers, you can see real quick, he wasn't able to save the full 500. He actually was only able to save $491.25. You might be asking yourself, well, why? Why didn't he just do 500? Remember I said these are specially designed and engineered policies, which means we actually have to follow some rules set by the IRS. And based on the amount of money Kevin was putting in, the 50 grand, and the amount he wanted to save, and his age, he was about 38 years old, he couldn't put the full 500 in. Hence, he could only do 491.25. So now you know the numbers. He changed one thing, and that's where the money went first. Now, how much money did Kevin actually have access to? Because that's the important thing. If he finds a deal, an Airbnb that he wants to buy, he needs to access that money. So by the illustration, at the end of the first year, he would have $51,554, which means he had access to over 90% of his original deposit. His original deposit after 12 months would have been $55,895. Okay, you got it? But you see, let's just assume that Kevin doesn't find an Airbnb, goes on privatemoneyclub.com and finds somebody on there that needs $50,000 for their real estate deal. And that person is willing to pay Kevin 12%. You see, if in the first year Kevin took $50,000 as a loan from his policy and gave to that person on privatemoneyclub.com, and he did that in a first secured lien position, meaning he gets a mortgage on the property that he's lending on in first position, plus a personal guarantee, because Kevin's not wanting to take a lot of risk, so he makes them sign a personal guarantee, and he lends that money for 12 months because he says, you know what, I think I'm going to wait 12 months before I decide to buy my own property, and I can make this money pretty easily by being the bank. So he lends that 50 grand. How much money's left in Kevin's policy if he puts 55,895 in and he lends 50,000? Now I know some of you are doing the math and you're thinking 55,895 minus 50, that means he's got 5,895 left, right? Wrong. That means he's got 55,895 left in the policy. Hold on, that's not correct. He doesn't have just 5,895 left, because remember I said at the end of year one, based on his illustration, he had 51,554. So how much money's left in his policy earning interest and dividends? And his policy paid him 5.2% dividends and interest. Well, he's got 51,554, of course. So you're probably thinking, well, that doesn't make any sense. Where'd the 50 grand come from that he lent on Private Money Club? Well, that money came from the insurance company. The insurance company went into their general account and made a loan to Kevin. Now you're already thinking, oh, that's bad. Why would I borrow my own money? Well, you would, because what I'm going to tell you next. You see, the insurance company promised Kevin that they'd pay him a guaranteed interest rate. Then they also promised that they'd pay a death benefit someday when Kevin died. So that 50 grand that he took out as a loan, that was 50,000 from his death benefit. So it was a loan, but it's a loan Kevin technically doesn't have to pay back. Yes, the insurance company is going to charge interest on that money, and when we did this policy, 2023, the interest rate was 5%. So he borrows the money from the insurance company at 5% simple interest, and he earns 5.2% on his money gross. Now, that's 5.2 before cost of insurance, 5.2 before commissions, and 5.2 before policy service fees. So Kevin doesn't actually net 5.2. So you're probably thinking, all right, well, Kevin's losing money. You're right, in the first year, Kevin does lose money for doing that loan, except for Kevin makes 12% on the money. So Kevin's making money on the 12%, but losing in the spread. Well, let's go to year two. You see, year two, Kevin puts 5,895 in the policy. That's $491.25 a month, as you can see. And how much money can Kevin take out in the second year? Well, if you look at non-guaranteed cash value increase, and non-guaranteed means it includes the dividend, which is not guaranteed, he could take $7,141 after dividends are paid in the second year. So he puts in $58.95, and he can take $7,141. That means his net gain in the second year is $1,246. So if we look at that, that's net of cost of insurance, net of policy commissions, and net of policy service fees. He actually made $1,246 that year, which if we divide $1,246 into the $58.95 he put in, he made a 21% cash on cash return, as you see. So how does Kevin make money the second year? Well, let's say he finds a place to put $7,141, or let's just call it 7 grand. So he takes another loan, a second loan. The first one still hasn't been paid back, but he takes the 7,000 and he then loans that money out. How much does the insurance company charge him? 5. How much did his money make in that second year? Well, that year is $58.95 made 21. So 21.14 minus the 5% is what? A spread. Who makes the spread in the second year? Kevin does. In the third year, in the fourth year, in the fifth year as shown, the fifth year is he made $15.44. Okay, that's 26% minus the 5. Do you see what I'm saying? Kevin lost the first year, okay? But he got a death benefit. And he got his money into his own private banking system, which is this specially designed policy that you're looking at here. But by the second year, he broke even cash on cash. We call that the efficiency point. So the amount of money he puts in the second year, he's making more money than what he put in. His policy isn't totally broken even yet, but he's at least in the money on any new dollars he puts in. And as he goes on and does this over and over, whether he's taking money out for an Airbnb that he buys or lending money on privatemoneyclub.com in a first or second lien position, okay, it doesn't matter. His money continuously is earning compounding interest. Therefore, whether the money's in the policy or loaned out, he's still making these returns. The only thing that comes away from those returns is the cost of borrowing the money, which as of right now is just a smidgen under 5%. I rounded up to 5. Do you see how you can make money twice on the same dollar by changing where it goes first? Now listen, Kevin's numbers may not be the same as your numbers. Kevin's 38, he did a large dump in, you might not. So these numbers might differ, but it will not change the fact that the solution to what we're trying to do, which is be the bank and make a spread, doesn't change. I hope that helped you understand why when we lend money or when we're buying real estate, we always do it from a specially designed and engineered whole life. Why we choose to be the bank instead of using somebody else's bank. Why when we make 12% or make rental income from the Airbnb, we take that money and put it back into our policy as a loan repayment. Why? Because we want to control our money. And what I just showed you, what Kevin did and what so many other people have done is just that. They changed one thing and then added one step to the process. I hope you understand that. And I hope you liked this video. And also, if you liked this video and you want a little bit more info, check this one out right here, the Money Multiplier Method. It talks about the entire process and how the infinite banking concept can help you change your financial future. We'll see you next time. I hope you enjoyed.